Hi, everyone, and welcome to the tax law webinar. My name is Alex, and I'm going to be your host today as we review the current tax laws. This webinar today is going to be part of the educational webinar series that we'll be releasing throughout the rest of the year. So make sure that you subscribe to our YouTube channel in order to see our future webinar releases as well. So little context, currently we're in 2021. And the laws we're going to be reviewing were passed in 2017 through the Tax Cuts and Jobs Act. They're currently the law of the land, but are definitely subject to change in the near future, especially due to recent governmental changes. Regardless, there were some significant changes in the Tax Cuts and Jobs Act that were changes from the previous law, and they're definitely going to be worth reviewing today. So while today we'll be reviewing things more generally, if you would like to review how things impact your current specific situation, we definitely recommend talking to either your financial advisor or CPA or whoever you get your tax advice from. All right. So we're going to first start with an overview of the new rules. So it's important to understand a little bit of context around the most recent Tax Cuts and Jobs Act. So this tax change is the most far-reaching reform since 1986, and it impacts everybody widely across the spectrum. So it has changes for businesses, for people, small businesses, corporations. So it was a pretty wide-sweeping change. So for many people, they definitely saw a net positive in their bottom line. So it was considered more of a tax cut, but this didn't apply across the board to everybody. Definitely things have been continued to be interpreted and reviewed. And as it was written, all of the individual changes were actually written in the law to be temporary and set to expire in 2025. Everything except for the business related changes in there. So even if there is no reform before that, they're set to mostly expire in 2025. This new tax law adds an estimated $1.8 trillion to the national deficit. So goes along the lines of it being mostly a tax cut. And during its time, it lacked bipartisan support. So unlike most previous big tax laws that have had more bipartisan support, this one was more one-sided, which probably opens up to being reversed or amended in the upcoming years as things are now. So for the presentation today, we're going to be guided by four keys to the tax law. So these were the biggest changes for the Tax Cuts and Jobs Act of 2017. So key number one is that the many deductions that you previously may have been used to have been eliminated or changed. So we're going to be going through those. Key number two is that where you live makes a difference. So the impact of the tax changes impacts people differently based off of like the state that they live in. Number three, a wide range of family related tax issues. So things about schooling, college accounts, marriage, retirement, and things like that. There are a few changes there that we're going to be reviewing as well. And then the last key, the fourth key, is that businesses and small business owners are going to face some rule changes as well. So we'll review those for all of you small business owners and people that work for businesses out there. So we'll start with the first key about the deductions. So here are a few items you should know about new deduction rules and tax rates. So first thing to review is tax brackets. So one thing to note is that there are still 7 tax brackets. So that has not changed since the previous tax code before 2017. But one significant change is that for the most part, the tax rates in the tax brackets have lowered. So if we take an example of somebody who is single and makes $50,000 per year, in 2017, they would fall into the marginal tax bracket of the 25% tax bracket. And with the current tax law, as it is in effect in 20 and also in 2021, they would only be in the 22% marginal tax bracket, so a lower tax bracket there. Same thing applies for somebody married filing jointly that maybe brings in a household income of $100,000 per year. previously were in the 25% tax bracket and now would be in the 22% tax bracket there. Another big change has to do with the standard deduction. So the amount that one can take as far as the standard deduction has nearly doubled. So now the standard deduction for someone who's single is $12,400, where previously back in 2017 it was $6,350. So that's almost doubled. In addition, for married filing jointly, the standard deduction is up to $24,800, where it was previously at $12,700 before. So that's doubled as well. So one of the big impacts of increasing the standard deduction is that more and more families will be filing with the standard deduction rather than choosing to itemize their deductions like they may previously have chosen to do, which I think had the goal of making the tax code a little bit simpler. In addition, the new tax law eliminates the personal exemption of $4,050. So that's the personal exemption that one would get for each member of the family. So that's been eliminated. So previously, if you had a really large family and were taking a lot out for the personal exemption, this may impact you negatively, the fact that they've gotten rid of that. In addition, they've changed the AMT exemption amount where it kicks in. So it previously used to kick in for individuals that make over $54,000, but now with the new law, it's over $72,900. For married filing jointly, it's now at $113,400, whereas previously at $84,500. So basically what this means is that less people are going to be paying AMT taxes as the AMT exemption amount kicks in at a higher level. Some other elimination or deductions that have been eliminated are some miscellaneous deductions. So now you can no longer deduct a few additional things. So this includes moving expenses, home office expenses, investment fees, tax preparation fees, professional dues, and casualty loss in most instances. So these are just some miscellaneous deductions that have been eliminated in the Tax Cuts and Jobs Act. You can also now deduct more of your donations to charitable organizations. So previously, you were able to deduct up to 50% of your adjusted gross income in a charitable donation. However, with the new law, they have increased that to 60% of adjusted gross income. So you can now deduct a bit more when donating to charities. And this probably will have the impact of nonprofits seeking bigger donors who can now donate a higher percentage of their adjusted gross income over to those charities. So moving on to key number 2, which is the key that where you live makes a huge difference in how the tax law affects you. So point number 1 here is that homeowners in high tax states now lose the ability to fully deduct state and local taxes, also known as SALT taxes. So previously, you could, in any state, deduct the state and local taxes that you paid. So this was beneficial for people that lived in high state tax states because they would have bigger deductions and therefore save more money on their federal taxes. However, now with the current tax law, with the Tax Cuts and Jobs Act, the deduction for SALT taxes or state and local taxes has been limited to $10,000 total. So this includes your local taxes, your sales tax, your property tax, and any other state income tax. You can now only deduct that up to $10,000. So people who live in high tax states that maybe are previously used to deducting more than $10,000 might be negatively impacted by this change here. All right, moving on to key number 3. So key number 3 is some family-related tax rule changes. So these are some changes regarding children, education, high earning couples, divorcees, retirement, and estate planning. So these are all things that may require your attention if they apply to you. So we'll go through 3 family-related tax rule changes here. So the first one is the change to the child tax credit, which has doubled to $2,000 per child. So previously the tax credit was $1,000 per child, and again, now it's been doubled. So tax credit is again, after you calculate your taxes, you are able to take the tax credit against any taxes you owe. So it's a pretty powerful way to save money on taxes for those that have a lot of children or children in general. So this also applies to dependents other than children, but the credit is only up to $500. There is a phase out for this credit. So if you're an individual that makes over $200,000 or a couple that makes over $400,000, you will not be able to take advantage of this child tax credit. And this tax credit is even refundable, but only up to $1,400. So if you were subject to a refund and take the credit, you can only get up to $1,400 of that back when you do your taxes. The second family-related tax rule change has to do with 529 plans. So 529 plans are college accounts. So they're probably the most popular way for parents to send their kids to college. Previously, you were only able to take distributions from your 529 plan for college or post-secondary education. But now with the new law, you can actually take money out of a 529 plan for K through 12 education. There is a limit on this. You can only take up to $10,000 per year to pay for these expenses, but this has added certainly an additional layer of flexibility to 529 plans that might make them more appealing for families to utilize. Family-related item number 3 has to do with divorcees and how alimony is treated. So previously, alimony for the payer was a deductible expense and also was considered income to the payee or the person receiving the alimony. But now for all divorces after 2018, both sides, that's been eliminated. So alimony is no longer considered a deductible expense for the payer, nor is it considered income to the payee. So both sides have been changed as far as how alimony is taxed. Moving on to the fourth and final key, which has to do with businesses and small businesses. So all businesses will face new opportunities regarding how they pay taxes and what deductions and depreciation they can claim. So we're going to review 2 quick tax rule changes of interest to businesses. So this number 1, I'd say this is probably the biggest change that affects corporate businesses, is the change to the top corporate tax rate. So previously, the top corporate tax rate was 39.6%, but that has now been lowered to 21%. So the biggest corporations have been paying or are now able to pay a much lower corporate tax rate. In addition, the corporate AMT or alternate minimum tax has also been eliminated. So they have eliminated it that way to tax corporations as well. And one interesting thing to note here with this change is that as the change is written, these changes are set to be permanent, while most of the other changes that we've reviewed so far today are going to be considered temporary because they're set to expire in 2025. This one does not have a specific expiration date attached to it. Going through point number 2, so now small business owners get a 20% deduction for pass-through income. So this is definitely good news for small business and small business owners. So previously, small business owners had to pay pass-through rates all the way up to the 39.6% level. But the new law provides a 20% deduction on the pass-through income that they're reporting, as long as you're below certain income levels. So the income levels are $163,000 for an individual or $326,600 for married filing jointly. But basically for most small business owners, they'll only now be paying taxes on about 80% of their pass-through income, where previously, before this, they were paying taxes on the full 100%. Note that this business-related tax change is set to expire in 2025 as the law is currently written. So we went through a lot of material today, and again, thanks for bearing with me through all of these tax-related issues. Here's a reminder of some of the 4 key takeaways regarding the changes in the tax law that we reviewed. So number 1, many deductions have been eliminated or changed. Number 2, the high tax states are definitely feeling the tax pinch the most, and where you live makes a difference on how the tax law affects you. Point number 3, or key number 3, many family-related tax issues that need to address. So if through the presentation, any of those tax-related issues related to your specific situation, might be a good time to review and just make sure you're addressing that in your own personal situation. And then key number 4 is that business owners may benefit from a range of these changes. So we talked about the corporate tax law going down and also the additional 20% deduction on pass-through income that small business owners now have. Again, I already mentioned it a couple of times, but most of the changes that we talked about today were set to expire in 2025, pretty much all of them other than the corporate tax law change that we reviewed there. So next question really is, after reviewing this information, what is the best plan of action that you should take? So I would recommend starting by seeking professional help. So this can be from your financial advisor, your tax advisor, maybe a CPA. One thing that I would recommend is having the professionals that you work with coordinate with each other. So if you have a tax advisor and you have a financial advisor, maybe help them get together and so that they can coordinate and come up with the best game plan on your behalf. Right now we are in a pandemic, so there's not as many opportunities to meet in person with your advisor or your professional. But nowadays, like our team, most professionals are up and running and available via phone or Zoom, so they can meet you kind of on your own time. I would definitely make sure that you review how these rules impact you and your own situation, and start to keep an eye on the news for changes to the tax law, as I would not be surprised to see changes coming down the road. And of course, if you would like to schedule a time to review with me or a member of our Cetera Investors team, make sure you visit our website at toriandalex.ceterainvestors.com and click the Schedule a Meeting tab to schedule a time to meet virtually with one of us via Zoom. And we can go over this information from the presentation or any other financial questions or concerns that you might have. So lastly, just want to thank everyone for taking the time out of their day and joining us for this webinar. Make sure to subscribe to our YouTube channel and make sure to be safe out there and be well. Bye, everyone.